All right, so have you ever heard that phrase, making money while you sleep?
Oh, yeah, definitely.
That's what we're diving into today, the world of dividend stocks. And whether they can actually live up to that hype, that promise of truly passive income. We've got a great source here that walks us through everything we need to know, what they are, how to pick the right ones, how to actually use them to build that passive income stream, and yeah, even the risks involved.
Yeah, you know what I find really fascinating about dividend stocks is that they're not just, like a symbol or, a ticker. When you buy a dividend stock, you're actually becoming a part owner of that company, just a tiny little slice of ownership. But that ownership comes with certain rights, and one of those rights is the right to a share of the company's profit.
Okay, so you're telling me I could be like a mini CEO,
Yeah.
but instead of attending board meetings, I just get to sit back and collect these checks.
Exactly. It's like getting little thank you notes from your companies for being a loyal investor. The source we have here uses Coca-Cola as an example. Imagine you own a tiny sliver of Coca-Cola. Every time somebody sips a Coke around the world, you're theoretically earning a fraction of a cent.
Okay, I like where this is going, but I got to say, whenever I hear passive income, you know, I think about those get-rich-quick schemes. So is there more to it than just getting a check in the mail every quarter?
It's definitely not a get-rich-quick scheme. The real magic of dividend investing lies in the power of compounding. When you reinvest those dividends, you're buying more shares, and those shares earn you even more dividends the next time around, so it's like a snowball effect.
Oh, so you're saying instead of spending those dividend checks on a fancy coffee,
Hmm.
I should use them to buy more stock.
That's the idea. Let me give you an example. Let's say you invest $1,000 in a dividend stock with a 4% yield. That means you'd earn $40 in dividends per year. Now, if you reinvest those dividends consistently, your investment could potentially double in less than 20 years.
Okay, now you're talking my language. So I'm starting to see the appeal of using dividend stocks for both passive income and long-term growth. But with so many companies out there, how do I even know where to start? How do I pick the right dividend
Well,
stocks?
that's a great question. Not all dividend stocks are created equal. You want to look for companies with a proven track record of consistent payouts, companies with a strong financial foundation. Think of those household names that have been around for decades. Companies like Procter& Gamble, Johnson & Johnson, Duke Energy. These companies have weathered many storms. They have a reputation for stability.
So it's not just about chasing the highest dividend yield. It's also about finding those companies that are reliable, the ones that are built to last.
Exactly. You want companies that are like those sturdy oak trees that have stood the test of time.
That makes sense. But even those sturdy oak trees can be vulnerable to unexpected events, right? I mean, are there risks involved with dividend stocks?
Yeah, of course, you're right. Even the most stable companies can face challenges. One of the main risks is that a company could decide to reduce or even eliminate its dividend payments, especially during tough economic times. Remember what happened during the 2008 financial crisis? A lot of companies, even those considered stable, had to cut their dividends to survive.
Okay, so I'm starting to see that while dividend stocks offer this incredible potential for passive income, there are risks involved, just like any investment. Are there ways to manage those risks? Ways to protect my investments. So we've talked about how even those reliable companies can run into problems and how diversification is super important for managing risk. But when it comes to actually diversifying our dividend stocks, what does that really mean? Is it as simple as just picking companies from different industries?
Well, yeah, that's a great starting point. Think of it like building a balanced meal. You wouldn't want to eat only protein, right? You'd want a mix of fruits and veggies, grains, maybe even a little dessert.
Okay, I like that analogy.
Hmm.
So if we're building our dividend meal, what kind of ingredients should we be looking for?
Well, some sectors like consumer staples and utilities, they tend to be more resilient during those economic downturns. We talked about companies like Procter& Gamble, Johnson & Johnson, Duke Energy. People still need their toothpaste and soap. They need electricity and water no matter what the economy is doing.
Right, those are essential everyday needs. So those sectors are like the vegetables of our portfolio, providing that solid foundation and stability.
Exactly. But just like a balanced meal needs some excitement. We also want sectors that offer growth potential. Technology and healthcare are great examples. Think about companies like Microsoft, Apple, Johnson & Johnson. These companies are constantly innovating, developing new products and services, and expanding into new markets.
So those would be the protein in our dividend meal, providing the fuel for long-term growth and maybe even higher returns.
Hmm.
But as we're picking our ingredients, are there any red flags we should watch out for?
Absolutely. One important metric to consider is the payout ratio. This tells us what percentage of a company's earnings is being paid out as dividends. A high payout ratio, say above 80%, could be a warning sign.
Wait, so if a company is paying out most of its earnings as dividends, wouldn't that mean more money for me as an investor? Why is that a red flag?
It might seem a little counterintuitive, but a high payout ratio could suggest that the company isn't reinvesting enough back into its own growth. It's like someone spending their entire paycheck without saving anything for the future.
Oh, I see. So what would be considered a healthy payout ratio?
Generally, a payout ratio between 30% and 60% is considered healthy. It suggests that the company is striking a balance between rewarding shareholders with dividends and reinvesting in its operations for future growth.
Okay, so we've got sector diversification and payout ratio on our checklist. What else should we be considering when we're evaluating dividend stocks?
Another key metric is the dividend growth rate. This tells us how much the company has been increasing its dividend payments over time. Think of it like getting a raise every year just for being a loyal investor.
Now, that's an incentive I can get behind. A company that consistently raises its dividends sounds like a pretty good sign. But how do I find this information?
Oh, it's easy to find. Most financial websites and brokerage platforms will provide this information. You can see how much the company has increased its dividend over the past 5 or 10 years.
So we've got the payout ratio, which tells us how much of the company's earnings are being paid out as dividends, and then the dividend growth rate, which shows us how much those dividends have been increasing over time. Those seem like pretty solid indicators. But is there anything else we should be looking at beyond just the numbers?
You're right. While the numbers can give us a snapshot of a company's financial health, they don't tell the whole story. It's important to consider the company's overall business model, its competitive position in the market, and its long-term growth prospects.
So it's not just about chasing the highest dividend yield or the fastest dividend growth rate. We need to look beyond the surface and really understand the company's story, its strengths, its weaknesses, and its potential for the future.
Exactly. Imagine two companies both offering a 5% dividend yield. On paper, they might seem identical, but one company could be operating in a declining industry, facing fierce competition and struggling to adapt. The other company could be a leader in a rapidly growing industry, constantly innovating and expanding into new markets.
Okay, so I see your point. A high dividend yield doesn't always tell the whole story. We need to crack open the book, read the story, and understand the characters.
You got it. That's where research and due diligence come into play.
So how do we go about doing that research?
There are a ton of resources available online and through brokerage platforms. Read industry reports, analyze financial statements, stay informed about news and developments.
It sounds like we're becoming dividend detectives, carefully piecing together clues to uncover the most promising investment opportunities.
That's a great way to put it. It's all about separating the signal from the noise and finding those companies that are not only paying dividends, but also growing their earnings, strengthening their market position, and innovating for the future.
This is fascinating. It's like we're not just investing in stocks, we're investing in the stories of these companies, their journey, their evolution, and their potential to shape the future.
Exactly. That's what makes dividend investing so engaging. It's not just about passively collecting checks. It's about becoming an active participant in the growth of companies you believe in.
I love that perspective. It's about aligning our financial goals with companies that share our values and vision for the future. So we've covered a lot of ground in this deep dive, from understanding the key metrics of dividend stocks to emphasizing the importance of research and due diligence. But I'm sure there's still more to learn right on. What else can we uncover about this fascinating world of dividend investing? Okay, so we've talked about diversifying across different sectors, looking at things like payout ratios, dividend growth rates, and even doing our due diligence to really understand a company beyond just the numbers. But with all this information swirling around, how do we actually take action and start building our own dividend portfolio? Where do we even begin?
Well, building a dividend portfolio is like putting together a puzzle. You're carefully selecting each piece to create this cohesive and resilient whole. Remember those sectors we talked about earlier, like consumer staples, utilities, technology, healthcare? Think of those as the corner pieces of your puzzle, providing a solid foundation.
Okay, so I've got my corner pieces in place. Now, how do I start filling in the rest of the puzzle?
Well, diversification isn't just about spreading your investments across different sectors. It's also about considering different company sizes and even their geographic location.
Oh, so you mean I shouldn't just focus on those big name companies?
Not necessarily think of those large, well-established companies as the blue chips of your portfolio. They're like the sturdy pieces in the middle of the puddle, providing stability and consistency. But you also want to include some smaller, faster-growing companies, which might be a bit riskier but offer higher growth potential.
So those smaller companies would be like the more intricate, detailed pieces of the puzzle, adding complexity and excitement to the big picture.
Exactly, and don't forget about geographic diversification. Think about including companies from different countries and regions to reduce your exposure to any one country's economic or political risks.
So we're talking about creating this truly global portfolio, the tapestry woven together from different sectors, company sizes, and geographic locations.
Mm.
But even with all this diversification, is there still a chance that things could go wrong?
Of course, just like any investment dividend, stocks come with inherent risks. Companies can cut or eliminate their dividends, and stock prices can fluctuate sometimes quite dramatically.
So it sounds like I need to be prepared for a bit of a roller coaster ride.
Well, investing in the stock market is never a smooth, straight line upwards. There will be bumps along the way. But that's where having a long-term perspective really comes into play.
So if the market takes a dip, I should just ride it out and not panic.
Exactly. Think of those market dips as opportunities to buy more shares of those great companies at a discounted price. It's like shopping during a sale.
Okay, I like that mindset. But what about those dividends that I'll be receiving? Should I just pocket the cash, or is there a smarter strategy?
Well, one of the most powerful strategies in dividend investing is to reinvest those dividends back into the market, buying more shares of the same stock or diversifying into other investments. This is where the magic of compounding really kicks in, as your earnings generate even more earnings over time.
Okay, I'm starting to see how compounding can turn those seemingly small dividend payments into a significant force for wealth creation over the long run.
Exactly. And remember, as your portfolio grows, you can continue to prune and adjust it, rebalancing your holdings to maintain your desired level of diversification and risk exposure.
So dividend investing isn't just a one-time setup. It's an ongoing process of learning, adapting, and fine-tuning our portfolio as we go.
Exactly. It's about staying informed, monitoring your investments, and making adjustments as needed to stay aligned with your financial goals.
Wow, we've covered so much ground today. From the basics of dividend stocks to the power of compounding, the importance of diversification, and even the art of building a resilient portfolio. This deep dive has been an incredible journey.
And as we wrap up our exploration of dividend stocks, I want to leave you with this thought. Dividend investing is more than just numbers and metrics. It's about participating in the growth of companies you believe in, sharing in their success, and aligning your financial goals with the values and vision of the businesses you support.
It's about taking ownership, becoming part of the story, and letting our investments work for us while we sleep soundly, knowing we're on the path towards building a brighter financial future.
That's right. So go forth and explore the world of dividend stocks. Armed with the knowledge and insights we've discussed today, do your research, choose wisely, and embark on your journey toward financial freedom.
Happy investing, everyone, and may your dividends flow freely